Okay, good morning, everyone. I'm Elena Campbell with the Rochester Regional Chamber of Commerce. Welcome to today's webinar, three-letter words, PPP, NOL, QIP, and IRA, some 2020 insight. I don't know about you, but I only know what two of those mean. So we are going to learn today from our illustrious panel of experts what they all mean and why they're important to us. Three experts here with us, so I know they're going to be able to answer lots of our questions. So I'm going to introduce our main speaker, Leon LaBrecque, and then I'll have him introduce his cohorts. If you have seen Leon speak before, you know you're in for a treat. Okay, he's a CPA, he's also an attorney, but he's funny. How does that, I don't know how that happens. It's like an oxymoron, but he is hilarious, very entertaining. He can take a very dry subject and make it quite fun to actually learn about. So with that, here is Leon LaBrecque with Sequoia Financial Group.
Good morning, everybody, and welcome to Thanksgiving Treats. We'll go into our Thanksgiving treats first and what to do with marshmallows and peanut butter whiskey. No, Elena, thanks for having me here today, and thanks for having our panel here today. I'm joined by my colleagues, Bob Wines. Bob and I go back almost 40 years to Plant Moran. Bob is an expert in turnarounds, has done all kinds of things, worked with me on my own personal matters. Bob's a JD and a CPA and runs Insights 3. And is just a tremendous guy to know about getting all kinds of things done. He knows things about defense, he knows about everything else, but what he's really done is turn himself into the expert on PPP, finding something that he could be an expert on only for about 3/4 of a year. So I'm really proud of him for that judgment in terms of finding his expertise. I'm also joined by my fellow Michigan Association of CPAs board member. I'm privileged to be on the Michigan Association of CPAs board of directors. And Jamie Lopiccolo is on with me. Jamie is a CPA's CPA. He just does a tremendous job. I asked, when I have PPP questions I can't answer, I ask Bob, and then Bob asks Jamie and we get the answer. So my illustrious colleagues have made themselves into experts on things that have extraordinarily short shelf lives. Today we're going to talk about all those short shelf lives. PPP loans, there is some new developments that I heard today coming out of DC. One of the things that I find myself, one of the worst parts of my job is that I'm supposed to pay attention to politics and what's going on in DC, which usually is kind of like watching MSB, NBC, and Fox at exactly the same time on two simultaneous channels, or watching the Lions in Michigan State play at the same time. So it's just one of those troublesome and problematic type things. But we do have some new developments on the front, and then I'm going to have Bob and Jamie go through and talk about some of the things. I'll pop in a couple of points about some of our other three-letter words, and just maybe we can leave everybody with the ideas of what you need to do today. But on the breaking news front, news that I got out of DC is that now that we do apparently know who the president is for sure, there is a transition going on with McConnell, where McConnell is now entertaining a bill. And yesterday I wrote an op-ed, in fact, Jamie and I wrote an op-ed opinion with the head of the Michigan Association of CPAs and the head of the Small Business Association of Michigan, touting for some PPP corrections. The noise coming out of DC today is that may happen. We may get deductibility of PPP expenses. So if we get deductibility of PPP expenses, I think that would be a profound game changer. I also put an article out on Forbes.com today on when you should apply for PPP forgiveness. Jamie and Bob and I did a session yesterday with the Michigan Nonprofit Association, and we had different versions of what to do. Generally, I'll have my colleagues cover that, but under 50 grand versus over 50 grand versus over 2 million, all different sets of things. But the news is potentially we could see some change. We could see the Senate bill getting passed, Senate Bill 3612, and if you are a PPP recipient, it is worthwhile to send your senators a comment that you support Senate Bill 3612. If you want to go to your representatives, there are two bills, Bill 6821 and 6754. Both are very good for establishing the full congressional intent of the PPP. So I love coming with good news about what's going on in DC. The good news about what was going on in DC today is we may see some stimulus. The bad news is it won't be anywhere near the magnitude of the first CARES Act, but it will likely be an additional $150 billion toward the $138 billion I'm hearing on PPP, and potential deductibility. So with that, I'm going to pop it over to Bob and Jamie. Bob and Jamie, you guys are whizzes at when people should go do forgiveness. And you want to hit some of those latest new rules about the forgiveness applications and what we're seeing. I'd appreciate that.
Sure, let's do this. I'm going to attempt to share a screen. And let me know when and if you can see it. Is that viewable now?
Yeah, make it full screen, Bob, and we're in good shape.
Yep. All right, here we go. Okay.
I think you could actually just, there you go. You're good.
Here's really our, let's get rid of this. Okay.
Nope. There you go.
This is a quick summary of the major changes that we've seen, and these are rule changes that were issued by the SBA and the IRS. And what they're doing right now is they're saying if your loan is $50K or less, so you borrowed $50,000 or less, you do not need to worry about any forgiveness reductions for layoffs or wage cuts. So if you had 10 employees and you had to lay off 8 of them, beforehand, you might have a reduction for laying people off or giving people pay cuts. 50,000 or below, you do not need to do that. So the key for those, if you're 50K or below, oops, this is changing on me, sorry about this. No need to make any changes, no need to worry about any reductions for layoffs or wage cuts. That also means for documentation that there's no need to track the headcounts or wage data. You will not have any audits on that at all. And the form you're going to file is a 3508S. Now, when we say the form you're going to file is a 3508S, that's technically, that's theoretical. Because what's really going to happen is when you go to your bank, they're going to give you a portal and they're going to have the information that's on a 3508S. It's a very, very simple form. It's going to ask you for your name, your EIN, the amount you borrowed, when you borrowed it, and you're going to check off that you borrowed $50,000 or less. It's going to ask you, did you spend $50,000 or more on qualified expenses, which we'll cover in a few seconds. And you say yes, and you're literally done. There's a few certifications that you make, and you're over. That's it for the 50K or less loans. Jamie, any comments on that?
No, I think the biggest thing is just, the timing of, we talked yesterday a bit about the timing of when to apply for forgiveness. And I think that's the biggest, I think the biggest question that a lot of people have. The banks are starting to pressure. I'm starting to see banks pressuring businesses to start applying. And we kind of came up with a little bit of a matrix yesterday that those loans under 50,000, we don't see a need to delay applying for. Those between 50 and 150, we're waiting for additional legislation, so to hold tight. And those over 150 to 200,000 or to 2 million probably should wait anyways. And those over 2 million are going to be audited. So let's just get your ducks in a row before you do that.
Yep, I think that's a good rule of thumb. So in summary, we're basically saying if you're 50K or less, there's no disadvantage to right now just filing. So if your bank will let you go ahead, you're probably going to see, I only know of one bank so far that's allowing people who are under 150,000 to file.
Yeah.
But if you're 50K or less and your bank lets you, I would go ahead and file it if you've got the time. Keep in mind that the filing due date is 10 months after the end of your covered period. So for most of us, our covered period is going to be 24 weeks. It's 24 weeks from the date that we got our funds from the loan. So if your covered period ended in mid-October, I mean, you've got till August to file. So it's not a fire drill, but if you want to get it off your plate and you're 50K or less, we're saying, go ahead and file. It's a good time to do it. If you wait till next year, that's fine too. Now there's one other change they made, and this is an administrative change, and it's to try to simplify the process. If you're above $50,000, but you have no reduction in the number of employees, nor did you have any pay cuts starting from January 1st through the end of your covered period. So let's assume again, your covered period ended in mid-October. So from January 1st to mid-October, the end of your covered period, no pay cuts, no reduction in number of employees. They've simplified the form for you. We can use a 3508EZ, and we do not need to submit with that application all the headcount, the full-time equivalency headcount data. We also don't need to supply the wage data. You do need to retain all that data. So you do need to do the calculations. You need to keep those in your paperwork for possible audits. So it's not like if you're $50,000 or less where they're saying, we don't care about layoffs, we don't care about pay cuts. Here they're saying we care about it, but since you've told us that you've not laid anyone off from January 1st to the end of your covered period and haven't given anyone pay cuts, we're going to take you on your word for it, file the 3508EZ. It'll be the bank's version of that, and you're done. You can also use the 3508EZ if you happen to have reductions on headcounts, and the headcount date you're looking at is February 15th. So if you let's assume on February 15th, you had 10 employees. Let's assume you had to reduce from 10 to 5. But the reason you reduced from 10 to 5 is because of COVID rules from HHS, CDC, OSHA, et cetera. If because of those you had the reductions, then at that point in time, you can ignore those reductions, and you still need to track that, yes, I had my layoffs because of these reductions, which are COVID related, but you do not, you can file the FTE, you can file the simplified EZ report. You do not need to put all of your employee census data and wage data into the application, but you do need to retain it for audit purposes. Jamie, I have a question for you and for Leanne. Let's assume we're going through this and I've got a restaurant. So, and I'm obviously I'm going from at this point in time, 100% capacity to 25% capacity or 50% capacity. I'm assuming I could then use this to certify, and I could then at that point in time say, I'm using the simplified form. Would that be true?
Yeah, the easy form. Yeah. That would be my impression as well, just because of the fact that that's another safe harbor that you're allowed, that they ask they go through a series of questions, and if you've had reductions relative to any type of government type of restrictions, then you would still be eligible to do that. You have to check 3 boxes, and as long as you can fit into one of those 3, you're eligible to use the EZ form, and I believe that is one of them. So for those restaurants that are there that have seen reductions, the other thing that I want to comment on that is the instructions use the word direct or indirectly impacted by these CDC or these restrictions. So then that begs the question of who can argue that they've been indirectly impacted by that. So looking at your business, if one of your main customers happens to be a restaurant, let's say, and they've been reduced to capacity, and that means that let's say you're a service provider or a food supplier to a restaurant. Now, all of a sudden, you've been indirectly impacted because of the potentially they've been restricted, and so they're not having as much output and so forth. So you could actually argue that you have an indirect relationship to that as well.
Okay. Now, we're going to go do a quick refresher for all of us, which is basically, let's go through a reminder of what qualifies for forgiveness. Payroll cost is the big one for most of us. So it's your wages, health insurance, retirement benefits. And one of the things to keep in mind, when the PPP loan is originally started, remember it was for 8 weeks. The design was, we're going to give you money or loan you money. And if you spend it on these forgivable costs, some payroll and some non-payroll costs, that then those would be forgiven. You don't have to repay it. But they expanded it threefold. So it went from 8 weeks to 24 weeks. So I would say a key recommendation for us is you want to make your application as simple as possible. So if you can, try to, since you've got 24 weeks, see if you can get your full PPP loan covered by your payroll costs, just the wages. That will make your application much easier, because all you're going to need to submit then is your payroll service reports. If you're using Gusto, ADP, Paychecks, QuickBooks, payroll, whatever, you can submit those. You can submit your quarterly forms for the 941 and for the unemployment insurance, which is a 1028, and you're basically done. It will make your life much, much easier when you're applying for forgiveness. So I guess one of the things I'd say from a practical standpoint, as you're looking at this, take a look and see if your payroll costs over the 24-week period equals or exceeds the amount you got in the PPP loan. If so, you're good. You're basically done with the documentation. Just submit those. If that's not adequate, and for some of us, say in the restaurant business, we may have laid off lots of our staff and we don't have adequate payroll. Well, then we can go into the health insurance and retirement benefits if there's any there you can do. Then you can also pick up certain non-payroll costs. So if you've got rent or lease payments, your utility payments, and if you have interest payments that are secured, so if you have some equipment that you purchased on loans and those loans are secured by the equipment, or if you've got a mortgage on your building, the interest portions on those can be also treated as qualified expenses. Jamie, any questions or comments you want to make on those?
No, I think that what I've seen, and I'm sure most people have too, is their payroll costs are covering enough. And keep in mind that the reduction, just because you've had a reduction of staff and you're able to not have that for the reduction to be a detriment to you, the fact that you may not have incurred all the cost could be that offset. So don't think that you've got automatic forgiveness. If you still, at the end of the day, you need to have the cost to get the forgiveness.
Okay. I'm going to throw one little twist in for the payroll costs. And this is for the owner employees, the self-employed. And if you're running a Schedule C business, you're self-employed. If you've got a company, a lot of us have S Corps, et cetera, LLCs taxed as S Corps, or you're a partnership, then you're an owner employee. There's some caps on that. If you're using an 8-week period for your covered period, which you can do, there's no rule that says you cannot use the 8-week period. Just the 24-week is probably more beneficial for most of us, because if it's a longer period to grab payroll. But if you do, owner, employee, self-employed, and partners, the most that you can treat as forgivable compensation is $15,385 per partner, self-employed, or owner employee. So that's a cap. It doesn't matter what you paid yourself actually, that's the most you can treat as forgivable. If you use the 24-week covered period, the cap goes to the lesser of $20,833, or you look at your 2019 W-2, divided by 12, multiply it by 2.5, and if that cap is lower than 2833, you got to use that. So if you're an S Corp owner, self-employed or general partner for health insurance, you have to exclude health insurance from your payroll calculation. So this is nuanced. I would say when you get to this level, you really want to rely on your CPA. Probably the most important thing to remember is this. If you're an owner, employer, or self-employed, you're going to have a cap. If you're using 24 weeks, it's probably around $20,000, and then see if with that cap, if you've got that plus your other employee comp, are you over the amount that you borrowed under the PPP loan? Jamie, comments, insights, additions?
Yeah. Essentially what they've said is that we're not going to allow the owners to basically take this loan and pay themselves with it. We're going to let you get forgiveness up to the extent that you had compensation in 19 and you used it. Because if we remember back, the 2.5 times is what we based our loan on. So they're just saying that we're not going to allow you to take more out of the PPP than what you borrowed on to the owner. Now, this doesn't apply to non-owners. So, and I haven't, Leanne, and I don't know if you've seen anything. I haven't seen anything relative to related parties such as paying kids and some other things of that nature that you may be able to do. But, so there are some ways to get around it, I guess, but just keep in mind that if your salary was 2019 and you borrowed on $10,000, that's all you're going to get for the forgiveness calculation.
Right. I agree with you. There is no direction on the related party payments that I've seen. I haven't seen a direction.
Yeah.
Okay. This is going to be a little more detailed than we want to hit because we want to get to your questions as quickly as possible. A lot of people have come up with final payroll. Let's assume that my cover period ended in mid-October the 15th, but I'm doing bi-weekly payrolls. So I've got one running from October 9th to October 22nd, that 2-week period. What portion can I pick up as forgiven payroll? You can pick up the period between the 9th and the 15th. You can take those days, even though they weren't paid till after the end of your covered period. So your covered period at the end of the 15th, as long as you pay it with your normal payroll, which in our example is October 22nd, go ahead, you'll only be able to pick up the payroll within your covered period, in our example from October 9th to October 15th. But if you're using 24 weeks for most of it, this is probably not an issue. You will probably have more than enough payroll, even without worrying about trying to accrue that last payroll. Jamie, any thoughts about this or just jump ahead?
I mean, this is pretty straightforward. I think that we talked yesterday that I haven't been really concerned about this above and beyond, this extra payroll date afterwards or whatever. Been just running payroll reports from the date of the loan proceeds to the date of the 24 weeks later, and just using that as a cutoff. 90% of the people I've worked with, and that's plenty enough, because again, let's just keep this in perspective. We borrowed 10 weeks worth of payroll on 10 weeks worth of payroll, but we have 24 weeks to pay that all out. Chances are most businesses have accomplished that during that time period. So, first run I would do is keep it simple, the KISS method, right, Bob? Keep it simple, stupid. Just run your basic payroll report, see where you're at, and then see if you need to adjust if you're short, to figure out what you need to do. I think and we haven't gotten to it, Bob, I think the biggest thing that people need to the first step that people need to look at is really their full-time equivalents, is their payroll, that employee count. I think most people will have the expenses. I'm worried that they may not have the proper full-time employee head count.
Okay.
That's my concern.
We'll hit that in just a second.
It's a segue, Bob. It's a segue.
Yeah, but there it was. You're just one slide ahead of me. Non-payroll costs, just for most of us, you aren't going to need to go to non-payroll costs, but if you do, keep in mind, it's the non-payroll costs, which again, it's your rent, it's your utilities, it's interest on secured loans. They have to be paid during the covered period, or they have to be incurred during the covered period and paid by the next regular billing date. So for our purposes, keep in mind, if you have to use non-payroll costs, look at the end of your covered period. If you have any utility bills, if you have any rent, if you have any mortgage payments or loan payments, make sure they're paid on time, even though they come after the covered period, so you get as much of that as possible. Don't pay them late. If you pay them late, you could potentially lose that last portion of the payment. So I think that's good enough for that. Any other comments on that one, Jamie?
No.
Okay. Okay. This is where we're going to start looking at our loans that are greater than 50,000. And this is where we start talking about what happens if we start reducing our full-time equivalents. So we had to start laying people off. The reason we're saying it's for loans greater than 50,000, because remember, if you're 50,000 or less, these rules don't apply.
Did we lose Bob?
Oh, I thought it was me. Oh, yeah. I always take a screenshot of that when that happens, just to send it to him.
Yeah.
Bob, you back?
There, he's back.
Oh, did I disappear?
Yeah, you did. But it was a great conversation, Bob.
And boy,
Was it-
your face looked
You know,
great.
it's the only.
Fantastic.
Uh-oh, there he goes again.
All right. I think what we'll do is
Poor Bob.
that is kind of a great screenshot. So anyway, so we lost the screen because it looks like we lost Bob as well. But
Yep.
can you, Elena, if you want to, share with me, I can bring up the rest of the.
Yep, I
I
will.
guess you should have made me co-participant. Sorry.
That's okay. We'll get you in here right now.
Hey, Jamie, Pete has a great question on the easy
There you
form
go.
on the
Yeah.
justification of not bringing back employees during the partial shutdown. You do have that special HHS type thing. It's right on the slide, Pete. So you can't return to February 15th FTE levels because of guidelines issued by the HHS, CDC, or OSHA. So I think Pete's in the situation where they had to lay people off or they couldn't bring everybody back because of the governor's orders. That is one of the exceptions to the rule, right, Jamie?
Yes. Capacity issues relative to that's one of the safe harbors when you've got issues where you've got restrictions relative to the HHS, CDC, or OSHA. Yes, that would then allow you to file for the easy form. So I don't know where necessarily Bob left off on this particular slide. I think this is the slide he was on. Yeah. So where we're going with this is that the biggest change on this one was, again, the FTE safe harbors. There's two of them now that are out there. And the second one that we just talked about was the new one that they added. The first one was relative to layoffs. If you happen to have layoffs between the February 15th and the 26th, then you brought those levels back. They basically said that we're not going to allow for that FTE reduction to count against you, and you can assume your FTEs were the same as they were before. The key to this one that I want people to understand with this is, and this is where I don't like the fact that banks are pushing for forgiveness early, is that the FTEs, they say basically it's the earliest of December 31st or the date that you submit the application. So I've ran into a few clients that have gone through and have had reductions, but have had, because of the fact that they've had a longer period of time to stretch the payroll over, have met the total cost, but they may need to restore those people by December 31st. This is why I can't stress enough that I think that the biggest and first step that everybody needs to do is get a handle on where their FTE count is. Where was it at the reference period, which going back to that is either from February 2019 to June of 2019, or January 1st of 2020 to February 29th, 2020. Get those numbers and compare them to where you're at now. You may think that you're great on the cost that you've incurred, but you may be short because of the FTEs. I mean, for example, and I've said this before, I had a client that laid off one employee. He had two employees, him and another employee. Laid him off. Now, obviously, he was going to get the borrowing, but if that employee wasn't back by December 31st, he loses 50% of his forgiveness number. So the idea is that even after you run past your covered period, you still have time to make up that full-time equivalent levels. So keep that in mind, that don't rush to do forgiveness until you've looked at your FTEs effectively. Welcome back, Bob.
Well, thank you.
And
So
now
I
finishes up Bob's part of the presentation.
Yeah.
I like this much better.
So this next slide talks about the reductions that are allowed relative to FTEs. They've acknowledged that every business may not be able to bring their staff back to the same levels, and so they've allowed for certain things to be not counted against your reductions, including the employee. You've asked the employee to come back, and they say no, we don't want to. The employee's voluntarily resigned. That you've terminated them for cause or requested hours reduction. and you didn't fill those positions by any new employees. What I'm going to caution people to do on this is make sure you get this formally documented. The Treasury has said that this needs to be written and documented, that the employee chose not to come back or ask for reduction of hours. And this is not required to be reported with your application, but you are required to maintain that documentation. So get this in writing. If an employee had called you and said, I'm not coming back, I'm too scared to work in the COVID environment, please I don't want to be here, then have them send you an email to that impact or something so you have that. And then the new one that they added, which is highlighted in green here, is the inability to rehire staff employed that was employed as of February 15. And if you haven't figured this out now, February 15th is the measurement stick on a lot of things, and can't find similarly qualified individuals by December 31st. Now, obviously, that's going to be industry by industry by industry. If for example, as CPA firms, we may not be able to find another CPA or somebody during that time period, but finding a general office person, might be a harder thing to document. So keep in mind that this is going to be an industry by industry type of, or business type of qualification. For example, I don't think we could ever qualify, Bob is too qualified. We'd never be able to find a replacement for him. So, we would be SOL, right, Bob?
Oh, that's wishful thinking. Yeah, my dog could qualify for me.
Yep. So Bob, I don't know if you had any comments on that or anything. I'm trying to move quickly so we get through the questions.
No, I agree. I think I would flip you the next screen, and I think that's probably the most interesting, or the one that really is going to segue on to other topics. I think we're kind of done with the PPP.
So this one here is again, we talked about this on the onsite. We have 10 months from the end of your covered period. So let's walk through this from a time perspective. The first PPP loans were mid-April. And then you went 24 weeks, was just short of 6 months. That puts you into maybe the beginning of October. And then you've got 10 months from there so you're looking at the July timeframe before you really need to consider having that forgiveness, before you really need to get that in. You've got plenty of time. And I think, as we've talked about this before, guys, is we're not finding any real negatives in delaying or waiting or being patient. It's not like if you don't do it now, you're going to miss something. It's not like the big rush at the beginning, right? The big rush at the beginning, we're going to lose these funds. Everybody's got to run for application immediately. We've given a good grace period to do this. Take advantage of it and do it very methodically. And there's still a lot of rules that we're waiting for, to be honest with you, including that leads into and Bob, I'll let you talk to the tax, unless you want me to talk to the taxability of this.
Leanne, why don't you jump into that? Because let me give the general rule, because what Leanne's discussing is going to be a change to the rule. Right now, if we have a $50,000 or $150,000 PPP loan and it's all forgiven, none of that forgiveness is taxable income, so we don't have to pick it up. However, from our perspective, for all practical purposes, it's as if it were taxable, because what they're saying is if we have a $50,000 loan that's forgiven, but we use that $50,000 to pay for, let's say, payroll expenses, we cannot deduct the payroll expenses for the $50,000. So yes, we don't pick up taxable income, but we lose deductible expenses. That's the problem that we're facing, and that's what the IRS has ruled under that IRS Notice 2020-32. Leanne, why don't you comment about what's going on with the new act again, with the proposed acts, and how that will impact this?
Yeah, Bob. There's actually been 2 IRS rulings now. So the IRS ruled originally that expenses that were covered by a PPP potentially forgiven weren't deductible. And then they recently issued last week that expenses, even if they were paid in a different year, weren't deductible. The AICPA and the MICPA and the Small Business Association of Michigan, and basically just about anybody with a PPP loan, thinks the IRS is misinterpreting Congress's intent. Congress, when they passed the Coronavirus Relief Act, said specifically it was supposed to be tax-free. And as you pointed out, if I take away the deductibility of interest, it changes the complexion of that amount. The bills that I had posted, and I posted it on our chat too, which if you feel compelled, contact your senator or your congressman. Both the Senate bill and the House bill reinstate that those expenses are deductible, which does profoundly change it. As you and Jamie pointed out, though, Bob, it doesn't really matter what in terms of applying. We're not going to file our tax return for a while. In fact, if you apply for PPP forgiveness now, you're not going to see the forgiveness until later. You're not going to file your 2020 return right away. So I'm going to just submit that, we should probably, we shouldn't necessarily wait it out, but I think in December we may see a bill, and that's where I'm seeing it right now. So it's pretty interesting. By the way, guys, we did have a chat question on sole proprietors. How does a sole proprietor document income payments, the PPP forgiven application? If they're under 50,000, Elena, they just go with the easy form, right, guys? I mean, if you're a sole proprietor, wasn't the maximum you could get for yourself if you didn't have employees something like $15,385 or something like that? And so that's under 50. Can't you just go do it? So Jamie, and I know Jamie, a lot of sole proprietors. What's the gig? It's pretty easy, isn't it? You're muted.
Jamie. You're muted, Jamie.
Sorry about that. So the sole proprietor, assuming that there's no employees with the sole proprietor, they're going to use their 2019 Schedule C as their documentation, which is what should have been used or provided at the same time of the loan application. So for that, the Treasury said the number is the same thing. So you've now have got automatic forgiveness and you're eligible to use the easy form. If that's assuming you have no employees, but if you have a sole proprietor with employees, then you have to look at the other facts and circumstances to determine whether the easy form is the right form based on employee reduction or FTE reductions or not, or if you've got any other circumstances. But typically it's going to be the easy form for just a 1099 sole contractor.
But if we're 50,000 or less, we don't even care about it, right? We just simply have to show, we'd have to track that we spent 50,000.
Yeah.
But we don't have to track head counts or wages or anything else.
Yeah. Yep.
Keep in mind, if it is employees, so if you've got on your company, you might have 2 or 3 people who are working for you on a consistent basis. You treat them like employees, but they're 1099s. Those we can't include in your payroll calculation. It's your W-2 wages or your other owner employees, or if you're self-employed, your self-employed income. Subject to that cap, which is for most of us, 20,855 or 2.5 months of last year's income.
Leon, I want to go back to this question from Peter that he's got in the chat saying, regarding the easy form, what is the justification criteria for not bringing back all our employees due to partial shutdown for our company from the governor? Is it based on overall drop in business from the prior year? I don't think that that's the right criteria for, I think what it is for the easy form for the CDCs and is based upon your business is regulated, such as restaurants, or the restaurants or entertainment industries are probably the best example to this, saying that where the government's come in and said, you cannot be operating at this capacity. You have to, or you cannot be doing any indoor service, or like we're at under the situation we're in right now where restaurants can't work indoors. You can only have carry out. That's a restriction that's been imposed by the CDC. I don't think that there's nothing in any of the rules that dictate or require a measurement of revenue. And so I want to be clear on that. I think it's that's going to be a case by case and due to what your restrictions are relative to relationship to the orders that have been given.
Thanks for clarifying that. That's good. Thank you.
Elena, what I know you've got multiple pages of questions. So my thought is unless Leon, you want to go into the NOLs and QIP and some of that stuff, or do we want to kind of go into the questions and see if they fit into those into the questions along?
Let me just hit a couple of points and then let's do the questions. I want to make sure we get time to do that. Just on the NOL, as CPAs, we can tell you that there's been a change for the whole year on being able to take net operating losses and deduct them and carry them back. So there's a huge opportunity here. Grab your CPA, talk to your CPA, get a good year-end plan. Make sure you've got your year-end plan out, because generating a loss in 2020 can be very, very attractive. There's an arbitrage situation where you could, if you're a C corporation, you could carry back 5 years. And in 2015, the maximum corporate tax rate was 35%, not 21%. And the maximum individual tax rate was 39.4%, not 37%. So using that arbitrage makes a lot of sense. It also means that you might want to take it, it clearly is the opportunity to do other things like Roth conversions or other things like that. On the QIP, they did clarify in the CARES Act what qualified improvement property is. So if you own real estate, you can actually take some deductions for some of the improvements to the real estate, and you can use those directly and can actually affect your NOL. And then last but not least, just one thing I'm seeing, and because I run money for a living, I'm a money guy. I am telling clients like crazy, let's go look at Roth conversions. If you're over 70 and a half, you didn't take your aren't required minimum distribution, which is now changed to 72. You've got room in your tax bracket. I can't see taxes going down a lot in the short period of time. I do see taxes going up just by the math of IRAs. So this is time to look at the IRA before year end. Doing some Roth conversions makes lots and lots of sense. So with that, let's go over to questions. Elena, the floor is yours.
Thank you. Thank you. Thank you. And I was trying to keep track of my questions because I knew during your presentation you would, some of them would be answered. So what is your interpretation of when a client has, decreased business activity due to compliance and therefore can file the Form EZ? You did that one. We're good. If you received the EIDL $10,000 advance and the PPP and can document how you used them for different expenses, so EIDL for rent, PPP for payroll, are both of them totally forgivable? I was originally told that if you received the EIDL 10,000, then 10,000 of the PPP is not forgivable.
That's correct.
That's it.
That's still correct.
That's still correct. Yeah. So if you had a $40,000 PPP loan and you had a $10,000 EIDL grant, what they're going to do, and let's assume you spent $60,000 on payroll, you'd say, oh, I can forgive all of my PPP. It'd say, great, but they add back any amount that you received under an EIDL. So what they're doing is they're basically saying you don't get the EIDL plus the PPP because they were both designed for the same general purpose. It's still a great deal because what you effectively received between the two of them is $40,000 tax-free, and you've received $50,000 and the extra $10,000 from the EIDL. It simply is going to be up to a 5-year loan at 2%. You can pay it early if you want, but it's a great loan.
Okay, thank you. I've heard that the EIDL advance offset to the PPP is now put back to the lender who made the loan. Is that correct?
I think what they're
EIDL directly from SBA, I thought.
Yeah, what I think is happening there is what happens there from a mechanical perspective is that the banks submit the loan to the SBA. The SBA then will look and reduce the amount of the forgiveness that they're authorizing and reduce the amount of the payment to the bank to pay off the loan by whatever the EIDL is. And so it'll be left with a shortfall. So indirectly, the SBA is paying the banks anything minus the shortfall for the EIDL loan.
Yeah, okay. What the SBA is going to tell them in our example with the $40,000 loan and the $10,000 EIDL, the bank's going to submit it to the SBA with $40,000, saying we think you should all be forgiven. SBA is going to come back and say we will pay $30,000 of the $40,000 because this company also received an EIDL loan for $10,000. So you're going to get a notice from your bank saying 30 of 40,000 was forgiven. The reason the last 10,000 wasn't is because you received an EIDL loan. So now you only have a $10,000 loan.
Okay. All right.
Okay.
Thank you for that clarification. This one you might not be able to answer, but certain clients are telling me that their PPP loan has been sold and there's no direction on who to deal with. So that's something they need to work with their lender on. Who was it sold to and how do I get a hold of them?
Yeah, we don't know how they are allowed to sell under the act. There's a whole bunch of provisions because that's a major issue for banks. They don't want to hold on to these things, but they are still, to my understanding, I have not gone into the detail about the banking rules, but yeah, your bank's going to have to direct you onto that one.
Okay, will there be any changes to the PPP process dealing with idle loans obtained after the PPP loan? If you had an idle loan prior to your PPP app, you could roll it into the PPP loan.
Right. That was a provision, and that's different than these. Let's say our example, we had the $10,000. That actually is under the idle loan program, but it's an EEIG grant. And I know these all things sound like diseases. You've got idle, you've got EEIG, but anyways, this is a different scenario. This is where you had a true idle loan, which means you've gone to the SBA, you've borrowed money, it's not forgivable, it's just a loan. But you could go under this program and they said, oh, you could actually increase the amount of your PPP loan by these idle loans within a certain window period before you applied for the PPP loan. If you applied for a PPP loan, then subsequently applied for an idle loan, which a lot of people did for working capital, those don't tie together. That second idle loan is truly a loan. You didn't get to increase your PPP. There's no forgiveness on that. It could still be a very wise thing to do because the terms can be very good, but it is an SBA loan.
Okay, I think one more question. When we had Robert Scott on a Q&A, he's the SBA Region 5 Director, one of the pieces of advice that he did give to businesses was that if they hadn't applied for an idle yet, that process was still available through the end of the year, and that perhaps they should consider doing that so that they would have some working capital, just being wise that, we're not sure. Yeah, and this was before the 3-week pause, right? That was announced, last Sunday. So he was saying, look, if you think there's any which way that you might need some liquidity, some cash, apply for it, get it, sit on it. You can pay it back if you end up not needing it. If you have already received an idle advance and a PPP loan, can we apply again for an idle loan to cover rent costs going through the winter and the fact that we're not in the office as much? If they already applied for, it sounds like, and received an idle loan, can they apply again?
I am not an idle loan expert in this area. I wouldn't think it would be a problem applying for a second idle loan. It is a loan that you have to qualify for. It is a true loan. They would allow you to have it or not, depending upon basically your asset base and your underwritability, I'll call it. But there could be a rule that says, no, you can only apply for one loan under the idle program. I do have one concern. Keep in mind with idle loans that there are fees to apply for those. So there's a cost there. If the loan is small, $25,000, or I think it's under $25,000, there's no collateral requirements. But if you're above that, there are collateral requirements. So that can be an issue. So, and also there are prepayment penalties under the idle loans. Now, those may have been waived.
Yeah, they're not, they don't exist, Bob. There's no prepayments on the idle is allowed to be prepaid.
Okay, so they got rid of that?
Yeah. my firm got an idle loan, so I know that there's no prepayments. There's a secured assets, but there's still no personal guarantee till you reach over 150,000. And my understanding right now is SBA is not giving out any loans on idle over 150. Is the last I heard.
Right. Okay. Yeah. So that's good, because originally when they came out, that there were still the 3-year prepayment penalty.
Yeah.
So it's good that those have been waived.
I guess it depends on when this person applied, because I know early on that they were only allowing for the grant money to come through, because it was all part of the same process. You applied for the idle and you asked for the grant or the advance of funds, and then they would do it all at once. But then I think some people were only getting the advance and nothing else. Some people were getting the full. So I think it would be at least worthwhile to look back at the SBA to see if you can go back and get the full idle and not just the grant. It may have been the timing of when you did apply. But I do agree. I will admit that I do agree with the gentleman from the SBA that did say get the money. It's 3.75% for 30 years. You're not going to find a cheaper source of capital. The only thing that I will caution people on is that there are restrictions relative to using the idle loan. You can't use it for capital expenditures, and there is some provisions on there about anti-bonuses and anti-distributions to owners and things of that nature. So just keep in mind that you have to be very careful while you have the loan, how you use the proceeds.
Great. Thank you. Thank you. And I think there was one more question in the chat. I received my PPP in May and idle $2,000 grant months later, then an idle loan for $25,000 in September. Where do I stand with all of this?
Get some good working capital. So the PPP in May, your 24-week period is probably just about up, if not already up. You're gonna all but $2,000 of your PPP probably will be forgiven. You'll end up at the end of the day, after the dust settles, you're gonna end up with 2 loans. You're gonna end up with a $2,000 PPP loan and a $25,000 idle loan. The PPP loan will be 1% over 2 years, if not, because you got it in May, unless you renegotiate for the 5-year, and then the $25,000 will be a 3.75% 30-year loan. I mean, essentially, I think that's where it's going to be at the end of the day, and all of them are eligible to be prepaid if you don't need the money.
Yeah, one thing to keep in mind, if your PPP loan probably will be at 2%, the 1% rate applies to the nonprofits. I think the 2% applies to the for-profit entities, but it's still a 2% loan. It's a great deal. You know?
Right. Right. Exactly. And I just want to reiterate, that's all the questions I see, and we got everything answered on my 2 sheet.
Within 2 minutes.
Yay. So Leon did type in the chat, and I just want to read it out loud because I know in our recorded version, the chat won't show up. It is Senate Bill 3612, and in the House Bill 6821 and 6754. So that's the legislation. If you want to call your representatives, senators, please do. And advocate for that. I just want to remind everybody, thank you for explaining NOL and QIP. Those were the 2 I didn't know. I am not a CPA. Don't want to be one. Thank you.
Especially in 2020.
Yeah. And that's why I really appreciate folks like you who do want to be CPAs and are enthralled by all of this. So we appreciate you so much. We want to remind everybody about the great takeout. Please support your local restaurants, especially over the next 3 weeks. It's very important to our community. So thank you again, Leon, Jamie and Bob for joining us today. We really appreciate it. Your expertise is just invaluable in helping our businesses navigate through this. So we appreciate you. Any final words?
No, just happy Thanksgiving to everybody.
Yeah.
It's great.
Happy Thanksgiving, and nobody needs to panic. Just be patient. This process will be is good. We'll get through it all.
Mhm.
Right.
I agree. Happy Thanksgiving.
Yeah,
Yep.
we'll
Thank
get to the
you.
end of the
Thanks,
road.
Elena. Bob,
Thank you.
Leon, happy Thanksgiving. Good to see you
Yep,
guys.
thanks,
again.
guys.
All right,
Jamie,
good to see
Bob,
everyone.
everyone,
Bye.
have a great holiday.